Hey, welcome to Stocks, Tech, and Beer, where we do exactly what it sounds like. We talk about stocks and technology while enjoying an adult beverage. Today I'm drinking wine, and I hope you're drinking something alcoholic as well, because it's going to make me sound more intelligent if you're slightly buzzed up. I kind of wonder if there's a way to enforce that. You think with all the artificial intelligence that Google has underneath its belt there, it could do something more useful than having these AI systems go out and misidentify black men in Detroit and have the police arrest the wrong guy. It's terrible out there. I think it'd be pretty easy for everyone to just have to put up their glass, say cheers, have the AI decide if they're drinking a adult beverage or not, and if they're not, cut them off. Google, that one's on me. You can have that for free. Um, Anyways, I'm drinking wine. It's a nice Pinot Noir from Cooper's Hawk Winery. It's their Lux edition here. If you ever want to join a wine club, highly recommend Cooper's Hawk. There's a bunch of those restaurants all the way from Milwaukee down to the tip of Florida, all over the East Coast, and wine club's amazing. Every month you get a wine tasting, you and a friend, you go there, you do that tasting, you're feeling pretty good and probably in the right shape to watch the show. So let's get on with the show today. Recently I got a text from a buddy, and it kind of stumped me. It was a rare time in the markets where I just didn't really have an answer to his question, which was, it's like, hey man, I got $10,000 I want to invest. How should I put it to work in the market? And I was like, bro, I don't know. Maybe wait. And that's not the answer anyone ever wants to hear. They come to me because they want to know what they should be investing in. I know what I do, so I felt bad for not having an answer, and it really got me to thinking. I mean, there's always a value somewhere. It's just a matter of being able to find it. And at that time, I was just so deep into my research, I just didn't really have an answer for him, and I felt bad. So now I'm making a video, and I'm going to send it his way and put it up on YouTube so everyone can watch it. But the reason why I just wasn't so excited about the market right now is the market just seems a little toppy to me. I mean, yesterday you saw the market do an intraday reversal I'd say about 4% of the NASDAQ. So talking about stocks, we'll follow the NASDAQ index. It's up about 1.5% and finished down a little over 2%. So that's quite a big intraday drop. And today it's, rose like maybe 1%, a little less, but it still lagged some of the other markets. So tech, which is a leader generally of the stock market, is underperforming. I think that's kind of a bearish sign in the short term. So I'm a little nervous. When I'm thinking about what to invest in now, I'm thinking safety first and then potential rewards. And what I think you can do there is look for what hasn't quite come back enough yet. And one sector that I really like for that is the insurance companies sector. I mean, insurance companies have just been beaten down, and they haven't recovered yet. Most are still down like 50% from their highs pre-pandemic, and that's a long ways. And it's not like everybody's going to die. And I really don't know why the property and casualty insurers are down. Nobody's driving anymore. No one's got anywhere to be. So cars are staying in the garage. Sure, they're giving you a little discount, but it's not enough to make up for the fact that no one's on the road. So I think property casualty for sure is a nice space. Reason for these companies to be as low as they are. Another thing maybe shooting it down would be interest rates being lower, since most insurance companies make a lot of money from their investments. It never helps, but it shouldn't be. You're not down 50% just because interest rates are staying stable or lower. I mean, there's ways to get around that if you're an insurance company. And traditionally insurance companies are one of the best investments you can make over the long run. That's how Warren Buffett made a lot of his money. Sure, Berkshire Hathaway started as a textile company, but most of his big investments were with insurance, and that's mainly what Berkshire Hathaway is now. It's an insurance company. They acquired Geico a long time ago. It's been one of his biggest and best investments, and he's just kind of picked out little specialty insurers along the way, and he's just got some amazing businesses out there that are just gushing cash flow. And one of the reasons why insurance companies work is because it really has two main streams of income. First, you have the business side of the insurance operation, and the one way to tell if that's doing good is the combined ratio. And what that does, basically, is it adds up the claim payouts, the expenses of the company, and divides that by the number of earned premiums. And this should be 1 or below. And as long as it's below 1, that means the company is profitable or in its operations. And I would recommend, if you're digging into insurance company, that's the one thing to look for, is to make sure it's profitable in its insurance operations, because you don't want it to be reliant on its investment operation to turn a profit. And if you do that, you're going to have a low profit margin anyway, and it's probably not a good investment. So that's definitely one thing to look for if you're doing your own homework. And then the other thing, or stream of income that these insurance companies have, is the float. You buy insurance, you pay out your premium, you're insured for the next 6 months in case you crash your car or whatever. And insurance companies collect that money first, because otherwise the only people who pay are those who crash their car, right? So you got to pay in advance in case something happens. It's not like, yeah, pay us if something happens. That'd be a little messed up, terrible business. So they have this money, and they hang on to this money for a period of time until the claims pay out. And they get to invest that money, and the money is called the float. And they get to invest it, it's going to be in safe investments most of the time. And you get to earn some income on top of your business operations too. So instead of, having let's say a 10% profit margin, let's say you get 3% on these investments too, all of a sudden that 10% turns into 13%. You got a more profitable company, and more money gets returned to the shareholders. And then if you're a really successful insurance company like Berkshire Hathaway is, you get to also have the investments in the long-term cash. So they're not paying all that money out again. They get to reinvest those premiums, and they can invest it for the longer term. So then if you get a good steward of capital at the helm, like Warren Buffett had been, you'll go out and buy some quality companies like American Express, Coca-Cola, lately Apple. That'll make the shareholders some more money. So it's really a double whammy. And so what you invest in right now. Oh yeah, and before I forget, nothing you hear in this video should be construed as financial advice. Even though I kind of know what I'm talking about, I'm really just a guy sitting in a dimly lit room getting buzzed up on wine. So if that's where you want to get your financial advice, go ahead. But I hope you do your own homework and do some research on top of this and make sure it fits into your overall investing allocation. But looking for insurance, I did mention the ETF a little earlier, and one of the main ones is the Spider S&P Insurance ETF, as ticker symbol KIE. And that's a basic way to get broad diversification into the insurance sector. But ETFs can be kind of boring. If you want some specific picks, let me look at my list here. I just bought a few, kind of gave them a half-assed due diligence through it, made sure the combined ratio was below 1, and they had good cash in the balance sheet, and made some money investing. And those 3 are American Financial Group, Access Capital, and WR Berkeley. I think they're high quality insurance companies. They're beaten down. I think I'm still down on most of those, if not all, from when I bought in. But I plan on holding for the long term, and I do think they'll bounce back. And hopefully buying at a 50% pullback was a good time to get in. But we'll see. And let's move on to the second group. And those are SPACs, or special purpose acquisition companies. You may also hear these called by nicknames of a blank check company. And it's essentially what they are. Someone decides that they want to raise some capital for the purpose of trying to bring a private company, public through their vehicle. So they raise $500 million, let's say, and they use that money in an attempt to buy a company that's private to bring them public. It works a lot like a reverse merger did 20 years ago. I think it's pretty much the same thing, just with a new name. But it's becoming a lot of the rage for how companies go public, and you see some pretty well-known companies doing that. Lately, I think the most famous one is Nikola, the natural gas or EV car company, truck company, whatever it is they do, the Tesla competitor for trucks. And they went public, it soared, went to like $60. And then you also had DraftKings and Virgin Galactic, the space company, went ahead and did a reverse merger to become public. Those are just 3 examples, but the reason why I really like these SPACs is they IPO for $10. And if the SPAC doesn't find a company to bring public in 18 to 24 months, whatever the terms are, investors get their full $10 back. It's written into the prospectus, the S1, and the way they're marketed. But you get a lot of upside with these SPACs as well, because if all of a sudden it turns into Nikola, you got $10 turns into 40, 50, 60, and for a safe investment, you just made 500% on your money. So I like that. The one thing to look for in this, I would say, is a good management team. You're going to want someone on the management who has some gravitas behind his name. Someone like a Chamath Palihapitiya, I think is how you say his name. He's a former Facebook guy, early employee, but he's the guy behind let me get this right because I screwed up the name, the Social Capital Hita Sophia Holdings Company. And the first one they issued was the one that brought Virgin Galactic public. So, I mean, this guy's a player. He'll get it done. And now he's got version 2 and 3 out there to look for. And then another one I like is the Foley Trasimene Acquisition Corp. The guy who runs this is Bill Foley, or William Foley, I don't know what he prefers to go by. And he's the guy who brought the Golden Knights to Las Vegas and is instrumental in bringing the Raiders there as well. Big player in the financial technology space, and those are probably the kinds of companies he's going to look to bring public through his vehicle. And I think that would be an exciting play. I think we'll see some great fintech companies go public through him, and those SPACs take off as well. And the third investment I would make is, this one's going to be really boring. I mean, a lot of people are going to like it, but it's a way to earn safe interest on your money right now. And if you're ever uncertain, it's the place to go. But it's not like this little hey, we're going to make 2% in a CD kind of thing. No, this place offers interest on your dollars of 8.6%. It's part of the new decentralized finance movement that's sweeping through the cryptocurrency community. And the company's called BlockFi, and I'm a huge fan of it. I have a little bit of money there earning interest. And what they have is called stablecoins, and these stablecoins are tied to the US dollar. So one of these stablecoins will but these stablecoins are stable, that's why they're called that. Most of these, if not all, are backed by actual dollars. So you don't have to worry about that. All you got to do is, it's probably a two-step process, unless you move a lot. You can wire money directly into BlockFi, but if you want to use an ACH and save, the $30 wire fee, you have to open an account at Coinbase. Probably is the easiest place to do that. Coinbase or Gemini. Those are the two easiest places to do that. Open an account there, put your money in, transfer your money over to BlockFi. You'll do that through one of their stable coins at Gemini or Coinbase. And you deposit your money into BlockFi, and as soon as the money hits, it'll start earning 8.6% interest annualized. Pays out monthly, whatever 8.6 divided by 12 is. You get that monthly out of your account, and it keeps going. So it's a pretty slick deal. I like it, and in certain times, 8.6%, that's a pretty good return. That's probably more than you can expect in a lot of places anyway. Historically, the market returns 9 to 10% a year, and that's what most people should probably be shooting for, and what I am in most of my portfolio. I have my fun money where I like to gamble and take some risk, and that's what we talk about here. But really, the core of your portfolio should be invested in safe assets where you're earning 8-10% a year. And if you put in a few $1,000s in that a year for 30-40 years, you'll retire a millionaire. And if you're interested in this, I got a link below. It's a referral link. You'll get $10 if you click on that, and I'll also get $10, which will help incentivize me to keep these videos coming. I'd appreciate that. And let's just do a quick recap. So the three things to consider are insurance companies, SPACs, and a BlockFi account. That's where I'd put my $10,000 right now. Cheers.